Hey guys, come on in for Tax Talk Tuesday. Going on a Tuesday, but it is definitely Wednesday. Happy Hump Day, everyone! Happy Hump Day. If you're catching us on the replay, go ahead and hashtag replay for me so I know you were here and you stopped by. If you are joining me live, let me know where you're checking in from. Hello, hello, hello. Come on in. I'm gonna give it a few seconds here though for a few more people to come in. If you are catching us on the replay, go ahead and hashtag replay for me. If you are here live, let me know where you're checking in from. Also, let me know what industry you're in. I always find that interesting as to who watches my content and who follows me when I'm giving information. But it is Tax Talk Tuesday on a Wednesday. I had a family, well, not a family emergency, but I had an emergency yesterday. So, y'all know me, I'm transparent. I'm going to share. But yeah, come on in, come on in, come on in. Join me. Come on and vibe with me here. Hey. And you'll see me looking between the monitors. I have multiple monitors and screens up. So, not that I'm ignoring any one group, but come on in. Hey. Hey, 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 come on in. Let me know where you're checking in from. All right, guys. So I'm going to go ahead and get started. Y'all know I'm not big on long intros and saying hi to everybody from every state. I don't know. I'm something I hadn't gotten into. I guess because I'm a very direct person. I want the meat. I'll fast forward through all the rest of that stuff. So, in real Tawana style. So today, let me introduce myself first. I am Tawana Bryant Osborne of Bryant Business Solutions. For those who do not know me or are not following me on IG, come check me out, The Transparent Accountant. I am looking to help you have sustainable financial solutions with proactive and not reactive accounting and tax planning strategies. Okay. So while we do file taxes, we look at strategies with tax planning to help you long term. We don't want the one and done thing. Okay. We want to plan so that we can have a better tax season each and every year. Okay, so what we're going to talk about today is some common mistakes that we make as taxpayers, things that we don't look at. One of those things is when we're doing transactions with family members. A lot of times people don't like to do business with family. However, we do business with family, be it bartering, discounting, giving away. There's a lot of times we provide special services for our family as well as our friends, but I'm speaking specifically to families right now. And when it comes to transactions between our family members, the tax laws, we don't think about them at all. We don't consider the tax laws at all when it comes to our family members, and we get trampled on. We get, taken advantage of a lot of times when we're doing business with our families. So one of the things that I want to talk about is some common situations that we may encounter as business owners, as family members to someone else. We may not even be in business, but we may be providing a service to them. And then the tax ramifications that come along with each of these encounters that we have. So when we're renting to a family member, let's say you, the taxpayer, you're renting a home to your relative for long-term use as their principal residence, okay? And the rental's tax treatment will actually depend upon whether the property is rented at fair market value or fair rental value, and that's the value that's comparable to properties in the area. Or as we do, we hooking cousin John up, and we giving him that little discount, little family discount, and we're gonna rent it to them as at less than fair rental value. So let's talk about fair rental value first. If we rent that property to our cousin at fair rental value, then it's treated as an ordinary rental property. And we have to report that on Schedule C. Losses are actually allowed and is subject to the normal passive loss limitations. Here's the thing, and I've encountered this, where a family member, one of my taxpayers, was renting to a family member and was not claiming that rental at all on their taxes. They're not taking advantage of depreciation. They're not taking advantage of anything, any repairs that they're doing to the home, nothing. Okay. We want to make sure that we are maximizing our value and we're taking advantage of everything that's out there for us. So what happens if we rent that same property for less than fair rental value? So when that home is rented for less than fair value, and that happens when your relative is the homeowner, we don't want to take advantage of our relatives now, okay? It's being treated and used personally. It's as if it's being treated and used personally by the owner. And that's where the difference is, okay? The expenses associated with the home are not deductible. Okay? It is not deductible and we cannot depreciate that property. So what happens, Tawana? What's the result or the conclusion of that? It's that all of the rental income is fully taxable and reported as other income on your 1040. So that's different than now filing that Schedule C. So if the taxpayer was able to itemize, the property taxes on the home would be deductible. And right now, a lot of people are not itemizing their taxes because the standard deduction is just so high. And a lot of people are not itemizing. But it's subject to the current $10,000 cap that's on state and local taxes as well. So keep that in mind. The taxpayer actually may also be able to deduct the interest on the rental of the home by treating the home as a second home instead. So that will give you back some of what you're losing because you're renting it at less than fair rental value. And this is something to consider when we're deciding, and may help you get out of some things, because you may not even want to rent to your cousin. Okay, let's keep it 100. You might not even want to rent to your cousin, and you can let them know I'll lose too much. On top of it, it's bigger than just letting you rent this property. Now, if you treat it as a second home, up to the debt limit on a first home and second home can be taken. You can take those deductions. Okay. So if you're treating it as a second home, you can take up to that debt limit. Now let's talk about gift tax issues that may arise depending on the difference between the fair value and the rent that's actually charged to the tenant relative, your friend, your cousin. When you charge that rent to them, and it exceeds the annual gift tax exemption, which for 2023 is $17,000. Now, if the home has more than one occupant, the amount of the difference would be prorated for each occupant that's there. So unless there's a large difference, $17,000 per occupant in 2023, that amount varied in previous years. If there's a large difference between the fair value and the actual rent, or other gifting was actually involved. So let's say you gifted them a vehicle too. A gift tax return may probably would not be needed in most cases, but there are some cases where that gift tax return is needed. So you need to make sure when you're renting property to your family that, or a friend, a really good friend, that a gift tax does not apply. And remember, when you're gifting below the market rent, you can't take advantage of the normal losses that you would if you were in fact charging them full rent, okay, in the market rent for that area. Now, but let's go on to, let's talk about parents transferring a home, the title of a home to a child. Because I'm starting to see this a lot more often. I'm starting to see as well, because we're experiencing a lot of loss right now, just in the world. We're experiencing a lot of loss. And I know in my family reunion group, they were saying, do a transfer on death and put these things in place. My number one model is it depends. Every situation that someone says on TikTok, IG, Facebook, YouTube, so any social media does not apply to everyone. So we have to be responsible for ourselves in applying these things or whatever is being stated for tax purposes. One of my favorites, everybody should not be an S corp. You know what I'm saying? Like, everybody should not be an S corp. Stop stamping S corps on your businesses when you should not even be an S corp. What are you using to come to that conclusion? Because Joe Blow said it. And I can save on self-employment tax. Do you realize your self-employment tax could actually come out as less tax than had you switched over to an S corp? All right, y'all know I'll go left quick, so let me come back right. Well, this is my left, but you know what I mean. So let's talk about parents transferring the home title to a child. Now, when someone passes away, the fair market value of all of their assets is tallied up. So just recently lost my mom, 2021, and we kind of are going through this now, interestingly enough. And when that family member passes away, the fair market value of all of their assets, we had to report all of it. Like, they asked me what is everything that she owns? What are all of her assets? What is the value of that? This includes her bank accounts, any large items, even the small items. Like, what is the value of your mother when she passed? What was that value? And included in that was her house. If the value exceeds the lifetime estate tax exemption, which it's a lot, $12,920,000 in 2023, then an estate, if it exceeds that now, then an estate tax return must be filed. And it's rarely the case. It's not typical. However, there are cases where it happens when you truly start adding all of this stuff up. Now, like I said, it's rarely the case because that value is so high. Now, because the fair market value is used in determining an estate's value, that same fair market value, rather than the descendant's basis, the person you lost, your loved one, is the basis assigned to the descendant's property that is inherited by the beneficiary. So when the beneficiary inherits that property, what was that basis? And the basis is the value from which gain or loss is actually measured. And I want you to be sure that you're tapping in. If you hadn't already, if you're not following me, follow, and turn your notifications on, because I'm doing, I won't say it's a series. I'm just going to be going over some basic tax term that we should know, okay? As taxpayers, we're responsible for us. And there's some terms that we should be familiar with, okay? And I'll be kind of talking about the definition of basis. Now, like I said, the basis is the value from which gain or loss is measured. And the date of death value is, if the date of death value is higher than the descendant's basis was, this is often referred to as a step up in basis. Now, if any individual gifts as an asset to another person, the recipient generally receives it at a donor's basis, which does not include a step up in basis. Okay. And I know it's like, well, Tawana, why you telling us all this? One, your preparer may not know. There was a period I didn't know, and we learn so much during tax season, and some of these things are hard to follow. Okay. Now, I also know that I have a lot of tax preparers that follow me. There are things that we don't think about or we don't have to deal with. One thing that I explained to someone, because they were saying, "Oh, I'm just going to leave that alone. I don't want to deal with that." Well, what happens when you get a client that has that? And that's how we actually learn. We get clients with these different scenarios and different situations that may arise, and then now we have to do our homework and we have to do more research. One of my mentees will tell you, I am big on research. I'm big on digging to find out, to make sure that we're applying things correctly. We are also human. So I still say, even though we're out of that whole COVID phase of the crazies happening, we still have a few crazies happening. Give us grace, as we should be extending grace to you, the taxpayers, as well. Okay. Now, a frequently encountered problem that happens, though, with the whole gift situation is when an elderly parent signs the title of his home to the child or another beneficiary and continues to reside in the home. Now, the tax law is very specific in these situations, and it's that an individual who transfers a title and retains the right to live in a home for their lifetime has established a de facto life estate. And as such, when that person dies, the home's value is included in the descendant's estate, and no gift tax return is applicable. So, like I said, we have to be careful when we're listening to everyone on social media. There's so many people out there, so much information. We are still responsible for us, and still responsible for at least understanding the basics of what it is and where our situation applies. And don't let someone just tell you, "Oh, this is what the process is. We're just going to do it like this." Ask why. Why does that apply, or does it apply to my situation? Okay. So in that particular case, the beneficiary's basis would actually be the fair market value at the date of death of the descendant's death. Okay. On the other hand, let's check this situation out. If you have an elderly parent and they don't reside in the home anymore, let's say they moved in with you, but the house is still there. They don't continue to reside in the home after transferring that title over. There's no life estate established in that situation. And as we said earlier, the transfer then becomes a gift. And then we have to look at the gift tax rules. And then the child's gift recipient's basis would be what the parent's basis was in the home at the date of the gift. So whatever that date was that it was gifted to the child, that would be what that basis is. In addition, if the child were to sell the home gain exclusion would not apply unless the child moves into the home at some point and meets the 2 out of 5 year ownership test. Okay. And we're talking about rentals here. Okay. And I'm not going to go into any other situations because that was already overload, because basis is difficult to understand. But I just want you to know the difference of transferring the child to a home to your child, if you live in the home versus if you don't live in the home, and then also renting to a family member and charging fair market value or less than fair market value, and how that affects you, because these things are going on. And while we talk about all of the Common things that happen. What happens with these things that are common that we don't discuss? And I know a couple of people going through these situations as we speak, but we don't talk about them. We're talking about what's easy on social media, and we have got to get a little more detail, give our audience a little bit more substance. And I know sometimes that stuff is hard to understand. If you have to rewatch the video a couple of times, rewatch it a couple of times. If something doesn't make sense, guess what? Got a free 15-minute discovery call. Hit the link in my bio. Okay. Now, the other thing I wanted to mention today was the incorrect withholding. So oftentimes spouses who are both working, they don't coordinate with each other when they fill out the form W-4 that they give to their employer for the purposes of determining their amount of income tax that's going to be withheld from their wages. And sometimes the lack of communication, married couples, results in a substantial under withholding of an unpleasant surprise at tax time. So mom and dad, 2 kids. Mom is claiming 2 kids on their withholdings on the W-4. Dad is claiming the 2 kids on his. Now you have underpaid because you're married filing joint, and there is a certain amount, depending on what your income is, that you should be filing. You missed it because both of y'all aren't taking out what you should be taking out had it just been you. Okay, so make sure that we are communicating, husbands and wives, in those community property states. Those are filing together on your tax returns. Make sure you're communicating with your partner if both of you are in fact working. And this situation happens also if you work a second and third job. A lot of times we are wanting to claim that on every single job, and that can cause an underpayment as well. So be careful when we have multiple jobs in the mix. Okay. And then what happens if a child files their own taxes incorrectly? So you've got your child that's working, woohoo, and hopefully contributing something, let them pay the water bill, light bill, something. And oftentimes a child who's eligible to be claimed as a dependent by their parents files their own tax return without checking if somebody can claim them. So I've seen this situation play out a lot where child will go, especially these college students, okay? Child will go, file themselves on their taxes, claim themselves, and don't say that nobody else can claim them, okay? Mama done paid tuition, everything else, but they got that lovely 1098-T and they want some money because their friend got some money. But make sure you're having a conversation. Communicate with your children. Make sure they understand, yes, you can file that if you need to file your taxes. Make sure they know, file your taxes, but be sure to put someone else can claim you on your taxes, so that, and that's if you're claiming them, parents, okay? If you intend to claim them on your taxes, make sure they're checking that box that someone can claim them on page 1 of the 1040. And it's usually right in the beginning. If the kids are using TurboTax, it's usually right in the beginning. Now, if the parent does claim the child, but the child already claimed themselves, you're going to get a letter from the IRS. And typically, what I've experienced is it rejects from the beginning. It'll say that social has already been used. So it's not even going to go through. And now, mama mad, daddy mad, because you can't claim the child that you were supposed to be claiming that have been calling you and nickel and diming you all school year long. All school year long. I love my college students, okay? So just make sure that you're communicating this with your children prior to them filing their taxes, because they might have just worked one job and they didn't got that W-2 back quick, and they're running to get that filed. The child may have actually claimed more standard deduction than allowed, and possibly could deprive the parents of deductions and credits that they are actually otherwise entitled to, okay? The remedy for this situation requires that the child's tax return be amended which we know can take some time. Now we benefit now because we can electronically file amendments. However, when we're changing the filing status, that still has to be mailed in. So it still can take some time and hold the parents' tax return up. So because I know I have a lot of my friends' children on my pages as well. If you are think about mom and daddy. Think about the fact that you're gonna have to call home, borrow a couple of dollars, okay? And don't go jump the gun. These are actually not the only examples of the tax and complications that can occur in family transactions. It's recommended that you contact our office before completing any family financial transactions. And I'm gonna do a series on that too. There are a lot of situations that taxpayers should be contacting their tax professional prior to doing all the great things. Congratulations on your new car. Congratulations on your marriage. Congratulations on the new baby. Congratulations on that major purchase in your business. But did you have a conversation with your tax professional, or do you just bring it to them at tax season and want them to work a miracle because you didn't plan properly? And some of these situations require strategy. That's going to be one of our words too. So just make sure it's better to structure a transaction within the parameters of the tax law from the beginning than to suffer the unexpected consequences that could occur after the fact. I just want y'all to be, aware. I want us to be educated. I want us to be empowered to make decisions. I want us to be empowered that we're not afraid to file our taxes. We don't get weary at tax time. We're excited because we're ready. Our books are done. My books was good the first week of January. I got my profit and loss. I've got my balance sheet. I'm ready to go for tax season. I did all the things during the year. I tracked my mileage. So I want to make sure we're up and ready to go this tax season. 2023 is going to be great. 2024 is going to be even better, because if you hadn't started doing all the things that you should have done for 2023, it's still the beginning of the year. If you hadn't been tracking your mileage, go ahead and start now. It's not too late. Go ahead and start now for the next year. You got another year. You'll be graced with it. If you've been graced with another year, go ahead and start now. Let's stop procrastinating. Let's stop saying, "Oh, I'll do it later." Stride Tax is the app that I often recommend. Stride Tax is that it's a white S on a blue app. Download that if you need to track mileage. Mileage you can take for medical miles, you can take it for business miles, as well as volunteer miles. Make sure you're tracking your mileages so you can get the max, take advantage of the max opportunities that you can on your tax return. Now, if you have not already gotten a copy of my tax organizer, we're still releasing organizers as we speak. If you have not gotten an opportunity, if you have basic tax returns or basic, and you could potentially itemize, don't knock it, because you may be able to itemize and don't realize it. Go ahead, go to the BBS bookstore, click the link in my bio, grab a copy of the tax organizer. I go through the organizer with you. I tell you what can be claimed. I tell you some tax law, give you some tax law with that, and take you directly through some of the tax rules that apply in those situations. But it'll also help you if you have a tax preparer and your tax preparer is asking for things that you're not familiar with or you don't fully understand. While you may be in a situation where you can ask your tax preparer some of these questions, you may not. Tax preparation is just that. It's tax preparation. It's not tax planning. So some questions may be outside of the scope of what you've hired your tax professional to do. And we have to know there are some boundaries when it comes to certain things. And if you didn't purchase that particular service, then they may or may not be willing to give you that additional information. There are a lot of great tax professionals out there that will break things down for you, but I've created another tool to help you along the way. All right, guys, that is it for Tax Talk Tuesday on a Wednesday. Be sure to like, share this mini training, this Tax Talk today. It may be able to help someone, friends, family, It may help you get out of something with friends, family, if you have some rental properties. All right. Have a phenomenal evening, y'all, and I'll talk with you later.